Hello everyone, welcome back to Macroeconomic Theory. Today we are going to start a new chapter on monetary models which are based on the real models we discussed in the previous semester. Now let's look at what we have been doing in the last semester. In the whole semester, we have developed this RBC paradigm initiated by Lucas and Prescott in the 1980s. They both win the Nobel Prize in economics for their contribution to how to build modern macroeconomic models. The baseline version of RBC model has no money, as R stands for real. Now, RBC stands for real business cycle model. If there is no money, then does that mean money is not important at all? Well, in reality, we do have money, but in this RBC model, we have a very fundamental assumption, that is, there is only one output. Now, this is something that we discussed in the RBC model setting. There is only one output. If there is only one output, then money is not needed, right? Because, for example, if you are in the labor market, then the firm pays some units of output as your wage. You are happy with that because there is only one output there. Let's say in this imagined economy, potato is the only output. So if you work for your boss will pay you, let's say, 10 units of potato as the real wage. And you're happy because you have nothing else to ask for, right? And in the credit market and capital market, you can borrow 10 potatoes, for example, from the bank. And later on, you will have to return 11 potatoes, for example, and that extra one potato is the interest, or real interest, because there's nothing else in this economy you could use to borrow or to lend. Okay, so if that is the case, then money is not needed at all. You don't need money to exchange for another goods, because the second good does not exist at all. In that case, people will just stick to one output to transact and to trade, and that's it. As we know, in reality, money doesn't matter because we have more than one output. There are millions or even billions of outputs out there. So in this case, if there is no money, then transactions will be very, very difficult, because any trade is only possible if there is a double coincidence of wants. So what is double coincidence of wants? This stands for that if you have something that I want and I have something that you want, then these two wants meet and they coincident, then that will make this transaction happen. So in reality, we don't have this coincidence all of the time. So it will be very, very difficult if we rely on double coincidence of wants to trade. Just show you where we are in the big picture. We start with the RBC model. And in this RBC model, we have two divisions. The first one is the static model, focusing on the labor market. And in the labor market, we have derived the intra-temporal condition. The intra-temporal condition is describing the optimal behavior of the consumer and the firm. They are linked by W. Okay, the marginal product of labor is equal to W for the firm, and for the consumer is W equals to the marginal rate of substitution between leisure and consumption. So that is the static model or static component of the RBC model. And then we extend it to the dynamic setting, where we have an intertemporal condition. And the intertemporal condition describes the optimal conditions for the consumer and the firm as well, but they are making decisions over time. So it's linked by the real interest rate. The interest rate should be equal to marginal rate of substitution between today and tomorrow's consumption, that is for the consumer. And for the firm, it should be equal to the marginal productive capital, taking into account the depreciation. So that is the two basic components of an RBC model, the static and dynamic. And then you can extend it by including some search and matching costs. and including some asymmetric information for the two models. And then at the end of the semester, we combine both static and dynamic components in the RBC model to have an all-in-one RBC model. But it's still a real business cycle model. There's no money at all. This intra and inter-temporal condition still holds for all-in-one RBC model because they don't interfere with each other when they make decisions within the period and over the period. Now we are in the monetary model chapter. In this chapter, we are going to build on the RBC model. Nothing has changed in the real side of the economy, and the only thing that has changed is that we have money in it. But when we put money into the RBC model, we have changed the fundamental assumption of the RBC model. That is, there are more than one output. Okay, in the previous RBC model, there is only one output, as we said in the previous slide. But now we can have more than one output. And money is just a special goods that is used as the medium of exchange in this model. And as the tradition of macroeconomics, we have two types of models. The first one is the monetary model without nominal friction. And the second school of monetary models are the models with nominal frictions. Basically, it means, can you change your monetary price as frequent as you want? Some models, like New Keynesian models and Keynesian models, they assume nominal friction, with which you will not be able to freely change your price over time. But there are also another type of paradigm. We will start with that actually, without nominal friction. They are following the new classical traditions. And that is where we are. We are going to introduce money to begin with, and then go to the two types of monetary models, with or without nominal frictions. So in this lecture, we're going to have three learning objectives. The first one is to know the three functions of money. It's actually the definition of money. The second one is to know how to measure money supply. This is a quantitative definition of money supply. The third one is to understand how fractional reserve system can create more money than those have issued by the central bank. And this is a very important mechanism all macroeconomists has to know. And this is also very important for exam because usually there will be one question coming out of this fractional reserve system. So today's lecture will begin with why we use money and the definitions of money, the types of money, and then goes to the money supply, how money is created through the fractional reserve banking system, and leave the demand side of the money to the next lecture. So the first question we would like to answer is, why do we need money? In the previous slides, we have mentioned that if there are more than one goods in the output market, we do need money because the double coincidence wants is really rare. But in what case money can be avoided? Now let's consider a 3x3 economy, 3 consumers and 3 goods. Let's see how difficult it is if you can have these transactions without money. Now these 3 consumers are respectively lecturer who wants food, like me, I want to eat food. The second consumer is the manufacturer who wants to learn economics, so he wants something from me. And the farmer, the third one, who wants plow. Plow is the tool you need to grow the food in the land. Okay, so they have 3 different wants, and they have produced 3 different outputs. The lecturers, like me, produces economics, so I can teach other people economics. The manufacturer, they produces plow, so they can produce these tools to be used by the third producer. the farmer who produce food. But as you can see, there is no double coincidence of wants between any two consumers. Lectures, me, I want food, but the food is produced by the farmer who wants plow, which I do not produce. And the manufacturer wants economics. He wants it from me, but I want food, which manufacturer doesn't really produce. Right? So in this case, no one can actually directly transact with each other. The only possibility is to coordinate, because the key is the food, right? What we can do is the lecturer wants food, so he has to exchange his knowledge, economics, to the manufacturer. The manufacturer doesn't have food to give it to me, so manufacturer has to give the plow to the farmer who wants plow, but the farmer only have food. Well, the manufacturer doesn't need food. He just get the food from the farmer and then give the food to me as the payment in exchange for the economics he learned from me. So in this case, this food is a key product or commodity. No one actually, well, not no one, but the manufacturer doesn't need food actually, but he can use this food as a currency in exchange for the knowledge. So this is like a money, right? Food is like the money in this transaction because it is used as a medium of exchange. So this is the coordination. In this case, there are 3x3 economy, but it needs a very complicated coordination process to make everyone happy. But think of millions of goods in reality. How can we have all these coordinations in one go and everyone gets what they want just by this complicated coordination? It's impossible, right? But if you have money, everything will change. So in this case, we're using food as the medium of exchange to facilitate transactions. It is also called commodity money because originally food is a commodity commonly recognized by almost everyone in this economy as a useful and valuable thing. It can also be a shell, gold, silver, copper, or even cigarette in the wartime. Alternatively, we can also introduce additional goods, an additional good which does not really have any value on its own. There's no intrinsic values in it because people realize that you don't really need it to be valuable to facilitate transactions. As long as everyone recognizes this as a tool, as a medium of exchange, then that can be used as money. And these kind of valueless money are called fiat money because you simply treat this as a commonly recognized medium of exchange to facilitate transactions. It can not be used otherwise. Fiat money includes coins, banknotes, and even bitcoins. As long as everyone thinks it is recognizable, then it can be used as money or fiat money. So what is money? Now let's turn to the answer to our first question of the learning objectives. The definition of money is defined according to its 3 functions. First of all, money has to be a medium of exchange. This is the defining feature of any money. It can be physical shells, it can be silver, gold, copper, or paper, but as long as it is recognized by everyone in this economy as a medium of exchange to facilitate transactions, then it is money. Secondly, money has to be a store of value. It can be stored over time. So think about food, which is actually not a good way of storing values, right? Overnight, maybe the food is of no use. So that's why the ancient people would like to use shells or metals as money, because they can be stored. The third function of money is a unit of account, because when you do transactions with other people, most of the time the value are different in every transaction, right? So it has to be divisible. If you want to buy a box of match, then 2 shells or 1 coins, that is very convenient. But if you are using, let's say, cow, how many cows you have as the unit of account, that is quite difficult, because a cow is not divisible. You can't say a box of match is worth a tail of a cow, right? It doesn't make sense. So it has to be divisible, and that is the third function of money. So it can be physical, digital, or even notional, as long as everyone thinks that is a medium of exchange. So here's a question. Is debit cards or deposits in your bank a form of money? Think about that. Yeah, can you use your bank account as a medium of exchange? Okay, this is the first question. The second question, how about credit cards? It seems like similar, but they are actually different. The answer to these two questions are different. Now, if you don't know the answer to this question, go to the textbook. There will be detailed analysis. So after defining what is money, let's look at how money evolves over history. The earliest form of money is always commodity money in most culture, because commodities are useful and valuable on its own. So that is why food or precious metals are usually used as the earliest form of money. But later on, when the economy develops, people find out that carrying gold on yourself to transact is neither convenient nor safe. So they start to build up banks where they put their metals in, and the banks will just issue some banknotes to prove that this guy has a lot of money. Okay, you can just use these banknotes as a proof of your wealth, and then you exchange these banknotes so that the transactions are quicker and safer. And later on, the banks find out that not everyone always wants their money back. They don't go to the bank every day to get their gold out frequently. So the banks can actually lend this gold to other people to earn the interest. In this case, the total loan they have give out in the economy may be larger than the total number of gold they actually own, because not everyone are coming back to the bank to get all the money out in one go. So in this case, this money are evolved to this commodity-backed paper currency, because the money in the economy will be greater than the actual volume of gold held by the bank. I will talk about that in details later on. This is actually the starting point of bank money. Okay, after a while, the governments realize that you don't really need anything to back up your money, as long as anyone in this economy recognize that this is money, then it can be used as money. So the government or central banks are invented, and they use fiat money instead of the commodity-backed paper money, because fiat money is not backed up by any commodity at all. And this is the difference between commodity-backed paper money and fiat money. And then the last way is the transactions deposit. Basically, it is generated by the commercial banks. Nowadays, you don't even have physical paper. When we go to shopping, go shopping, we basically use phones, right? You just have these digital numbers in your head, in your bank account. You don't even have a paper. And that is the modern way of transactions. And since 2010, you're old enough to know that this change, right? Before 2010, basically all the transactions are carried out using cash, but now we're more and more using digital money. The digital money can be centralized digital money, like PayPal, Apple Pay, or if you come from China, you know the Alipay and WeChat Pay. People there in China don't really use any physical money at all now. They just use this kind of digital way of payment. Or it can be decentralized. If you are interested in cryptocurrency, you should know that Bitcoin and Ethereum are the two most popular cryptocurrencies nowadays. These two types of digital money are quite different. The centralized money are controlled and issued by the same institute, for example, the central bank, or by some commercial banks. It's centralized because it's controlled and issued by these institutes. But decentralized digital money are different. They are not issued or controlled by anyone. It's just a new technology, and anyone is part of the transaction of anyone else. And it is decentralized. It's not part of the curriculum, but it is a very trendy phenomenon. And we may also use this cryptocurrency in our trading game later on. So probably if you're interested, you can take a look at what is decentralized money. I give you some hyperlink here. And if you want, you can click them to have a research. So our first job is done. We have defined what money is. And now let's look at money supply. Just like any goods, money has a supply side and demand side. And in this lecture, we are focusing on the supply side of money. We want to discuss how to measure money supply and how to generate money supply through the so-called fractional reserve system. Now let's look at how to define money supply. There are many ways to define it depending on where we want to draw the line, defining the feature of medium of exchange. That means if you want to use this money, you may want to involve some transaction cost to get it out from the bank. It is what we call liquidity. If it is very liquid, then this asset or this money is easy to get out of the bank. If it is involving a lot of transaction costs, then the liquidity is low. Now let's look at the examples in the US and in the UK or in the Eurozone. Okay, M0 is the narrowest money. It's a base for any other money. It is the physical money issued by the central banks. So it is the coins, notes in circulation in your pocket for the public. And it also includes the vault cash in banks. In all banks, they will have a bank vault. They store some cash in it. And the reserve in the central banks. It's the same for the UK and Eurozone as well, because they are basically the physical money issued by the central banks. M1 is less liquid, but it includes all the M0s as well. As you can see, M1 is wider. It includes M0 as the base. And it also includes the demand deposit in the US and the checkable or overnight deposit in the UK and the Eurozone. It's basically your demand account, or they call it current account in the UK. You can get the money out from the bank anytime you want, or from an ATM. And this is very liquid money, but it is not only the physical money, but also those you stored in the bank. The third type is M2. M2 includes everything in M1, as well as the small or short-term CDs. CD stands for Certificate of Deposit. It's basically the fixed account or savings account in your bank. And M3 includes everything in M2, but also those large amount or long-term certificate of deposits. And in the UK, it also includes the money market funds or repos and bonds. If you don't know what these things mean, it's okay. You can Google it, but it's not required for the exam. Actually, if you want to prepare for the CFA exam in the future, when you want to work for the investment banks, then these terms are quite necessary for you to learn. Okay, but not for this module. These are just different instruments in financial markets. Right, M4 is the widest or broad money for the UK. Anyway, it includes everything from M3. But it also includes CP. CP is the commercial papers, okay, treasury bills. These two are specific for the US. You don't have that treasury bill in the UK, but we have something similar. Okay, it's called government bonds in the UK. And in Eurozone and in the UK, we just include everything that is less than 5 years, but longer than 2 years. The CDs, CPs, and bonds that are less than 5 years in maturity, then that is M4. Okay, just you don't need to memorize all these details, but as you can see over the M0 to M4, the liquidity drops. As you can see, M0 is the ready money to use. Everyone knows that it's just physical money. You get it out from your pocket. That's M0. But over M1, M2, M3, and M4, money becomes more and more costly to withdraw from the bank or from the financial market. So that is how you define different types of money supply. The M0 has the highest liquidity, M4 has the lowest liquidity. Now we have finished the second learning objective, that is how to measure money supply. Let's now turn to the third, the last, and the most important learning objective of this lecture, how to create money. Having seen so many different measures of money supply in the previous slides, you may wonder why there are so many measures. In other words, you may want to know how these different measures are related and how money supply is created. To answer this question, we need to describe the whole mechanism of money supply, that is the so-called fractional-reserve banking system. To summarize, there are two types of money to be generated in this system. The first one is the central bank money. That is the physical money or M0 issued by the central bank. So this physical money or M0 is the liability of the central bank. It's like the debt of the central bank. The second type of money is the commercial bank money. It's the non-M0 components in M1 to M4. They are created and are the liability of the commercial banks. So the difference is who made this money. The key concept to understand the fractional reserve banking system is, of course, reserve. So what is a reserve? A bank usually accepts deposit and loan this deposit out to earn interest. But a fraction of the deposit is held as cash, just in case some people just want their money back. The rest, which are not part of the reserve, can of course used as investment or loans. There are two components of this reserve. The first one is required or required reserve. This is the minimum required by central banks. The other component is excess reserve, which are voluntarily held by the bank just in case there are some bank runs. More people than expected would like their money back. So this is the cash above the required reserve. The reserve required ratio, or sometimes known as the liquidity ratio, is set by central banks, and sometimes it is used as monetary policy tools to affect the money supply in the money market. It varies in different countries. For example, in the UK and many other countries, the reserve required ratio is equal to 0. That means a bank doesn't have to hold any required reserve in their bank vault. But in other countries, like those in the Eurozone, they have to keep 1% of their total deposit as required reserve. So you can't loan all the money you have out. You have to keep some of the money in your bank vault just in case more people want their money back. Now let's use an example to show how money supply are created through this fractional reserve banking system. Assume there is a person called Adam who owns £100 from somewhere. Okay, this is dollar sign, but I'm used to pounds, so I will use pounds from now on. Okay, Adam got this £100 from somewhere. This is cash, and this is issued by the central bank. So this is part of M0, right? This is created and issued by the central bank. So under the account of M0, that is the initial kick of the whole fractional reserve banking system. And we have this £100 to start with. If Adam would like to spend it to some shops, then that's the end of the story, because you don't really create more money. Some other person will just owns this £100. The total amount of M0 doesn't change in this economy. This is the central bank money. Okay, but if Adam decided to put this money into a commercial bank, then there will be more money created. How it is possible? Now let's look at how it works in this example. When Adam deposits its £100 into a bank, according to the reserve required ratio, the bank will have to keep £10, which is 10% of £100, as the reserve or required reserve in the bank vault, because that is required by the central bank. The bank can only loan out £90 to another person, let's say Betty. And Betty will get this £90. But this £90 will not be spent right away. Now, she will hold this money for a while, and she would like to put it into the bank as well. You know, that's how normal people do. You don't carry all your cash around. You put most of your money into the bank. So that is the second round. Betty deposit this £90 into a bank, let's say just the same bank. Okay, in this round, you created another money as the deposit. Right? In the first round, the £100 is the deposit. That's part of M1, right? It's how we define M1. But this £90 becomes the M1 as well, because you will deposit it into the bank. So M1 has increased by 190. But this £90, after Betty put it into the bank, it will not just lie there. The bank will use this £90 to invest again, but only 90% of this £90 can be invested. That means £81 of the deposit from Betty will be again loaned out to the third person, let's say Chris. Okay, so Chris will, just like Betty, he would like to keep his money into his bank. And in this case, £81 becomes a new deposit of the commercial bank. And after all, the deposits becomes deposit, but less and less. In this process, the whole M1 has increased in a proportional way in a geometric series fashion. And at the end of the day, you can see that this increment will be less and less, but the maximum of M1 will be much higher than the initial deposit of 100. So how much money supply can be created in this process? In theory, this is what we call geometric series. For each round n goes from 1 to 3n until infinity, a deposit dn can generate a new deposit by the loans. So dn plus 1, the new deposit, is equal to the old loan deposit multiplied by 1 minus RRR, which is required ratio of the reserve. So if you have already got dn in this round, some part of it is kept as reserve, but the rest of it can be loaned out. And those new loans will be deposited back to the banking system, so that becomes dn plus 1. If we iterate this formula backwards, that means we bring dn to dn minus 1 and dn plus 1 to dn, then we will have a new relationship between dn and dn minus 1. You see, we just bring the whole relationship backwards to the previous period because it holds for all periods, right? So that is the new relationship. If we put this dn into this dn, we will have a new relationship, which is also true. dn plus 1 is equal to dn minus 1, which comes from here, multiplied by 1 minus RR squared. Well, if we keep iterating backwards, we will have a formula here. dn plus 1, the new deposit, is equal to the first round deposit, multiplied by 1 minus RR to the power of n. N is how many rounds you have in this iteration. So we know that the first deposit is from the central bank, right? The central banks issued £100, and that is M0. It's held by someone in the economy, and he put this into the commercial bank, and that kicks the start. That's the first domino, and that kicks the whole series going until you have a very, very small increment that we can ignore. So finally, we have the ultimate M1 created in around n plus 1, which is our M1. The M1 component, which is equal to the initial kick, M0, multiplied by this 1 minus R to the power of n. So to summarize, the total money created by the commercial banks is equal to M0, which is the starting point of the whole process, multiplied by something. And this something is a power of 1 minus RRR. Okay, this is actually something we call geometric series, as we mentioned earlier. But if you are not familiar with the geometric series, you may want to click here for some more information. Okay. Now, if we keep iterating until infinity, the accumulated demand deposit. Now, every round we will have some new demand created. If we sum up everything in one go, if we sum everything up, then there is a formula. It is extremely simple. You see, the sum of all these deposits in each round from the first round to until infinity is actually equal to M0 divided by RRR, the ratio here. Now, this is the formula you simply memorize. You don't have to derive that, but it is derived based on the geometric series. Okay, so the sum of all new money created in the commercial bank system is equal to M0 divided by RRR. RRR is usually a fraction, something like 0.1 10%. Then M0 divided by a fraction will be much bigger than M0. So the theoretical M1, we say it is theoretical because we assume everyone will just follow this pattern. So there's no leaking out. There's no differences in each round. Everyone will just keep all the loans in the bank in this case. So in this theoretical assumption, the total M1 is equal to, don't forget, the definition of M1 includes M0 itself. So M1 is equal to M0 plus all the deposits created through the whole process. The total deposit created in the whole process is equal to this, M0 divided by RRR. So if you add these two components up, we will have M0 multiplied by 1 plus 1 over RRR. Okay, now you can clearly see that there are two components of M1. The first component, M0, is created by the central bank, or the central bank money, as we have mentioned. The second component is the commercial bank money. It is created by the fractional reserve banking system. So these two adds up to the total M1. So in our case, if M0 is equal to 100 and RRR is equal to 10%, then M1 is equal to 1100. That is, you have 11 more times more M1 than M0. And this multiplier here is sometimes called monetary multiplier. And in our case is equal to 11 because the original money issued by the central bank is only £100, but through the fractional reserve banking system, you finally created 1100. 100 becomes 1100. Magical, isn't it? In this simple example, we have a very restrictive assumption. That is, there is no money in circulation. That is to say, consumers and firms never keep any cash in their pocket. And for banks, they don't keep any excessive reserve. So all the reserves are required by the law, by the central banks. They don't keep any extra money just in case, because no one would ever come to the bank asking for any money. This is the assumption. In this case, M0, which is issued by the central bank, will be all go to the reserve. So the total reserve is basically equal to M0. There's no leakage from the banks to the circulation. In a more complicated and a more realistic model, of course, consumers and firms will always hold some proportion of their assets in cash. Now, for example, me, I will always have £10 or £20 in my pocket just in case some shops doesn't accept card payment. And let's call this proportion C1. This C1 is the proportion of cash you would hold as consumers and firms. There is another possibility that the banks may also want to hold a fixed proportion, let's say C2, of their deposit as excessive reserve, because if people want money, then there is a likelihood that people want more money today than usual. Then you will have to have this excessive reserve to satisfy this liquidity need. In this case, M0, which is issued by the central bank, will be greater than the total reserve because there will be some money in circulation. Some physical money are held by the public rather than by the commercial bank. So if we extend the basic model into this complicated model, nothing has changed in essence. We still have a multiplier equation. We have M1 equals to M0 multiplied by some multiplier. And this multiplier will be more complicated but not more sophisticated. You see, it is just 1 plus something, just like before. But now taking into account the likelihood by the public to hold money, C1, and the likelihood of excessive reserve, C2, then it becomes this long formula. But effectively, it's the same. M1 is created by both central banks, which issues M0, and as well as by the commercial banks. And this is the commercial bank's functionality. So if C1 and C2 equals to 0, that means the public doesn't want any money in their pocket, then there's no money in circulation, then this formula goes back to the simple case. The term inside the bracket is what we called money multiplier, just like in the previous slides, between M0 and M1. But similar multipliers can be defined for M2, M3, and M4. You simply have a more sophisticated formula, but everything is the same. The fractional reserve banking system is created by two banks, the central banks and the commercial banks. The essence is the central banks issues the money M0, and M0 will become new deposit and new loans and then new deposit, and this creation is done by the commercial banks. To summarize, we have addressed three questions in this lecture. The first one is how to define money. It's actually the same as the three functions of money. It includes the medium of exchange, the store of value, and the unit of account. So any goods that satisfy these three qualities can be called money. The second question is to answer how to measure money. The money can be distinguished according to the liquidity. The most liquid money is M0, which is issued by the central bank. It is cash, so you can use it anytime you want. There is no liquidity issues at all. But for M1 to M4, the liquidity decreases. That means you will have to go to the bank or wait for a while, or sometimes you even have to pay some transaction costs for you to use this money. And the higher the number here, the lower the liquidity of the money. And the link between M0 and other money is through the fractional reserve banking system. And we have discussed how money are created through this system by the central bank, which only issues M0, and by the commercial banks, which create loans and new deposit and new loans and so on. If you want to know more about the technical details of geometric series, you can go through the link I've provided in the slides. Otherwise, I suggest you to read Williamson, the textbook, chapter 12 and chapter 18, especially the first two sections of chapter 18, and try to do the self-tests. Have fun.